welcome everyone. My name is Aisha Millett. I am the president of the National Capital Branch of the Canadian International Council. We're thrilled to have so many folks joining us tonight, and I see that number continue to grow. Thank you for making time, for setting aside your dinner plans and joining us for what I am sure will be a fascinating conversation. For those of you who are new to the Canadian International Council, I want to just take a quick moment off the top to tell you a little bit more about this organization. It has 19 branches. It has 1,400 members across the country, with one of the most fascinating mandates, that of fostering dialogue on important foreign policy issues for Canada. We're hosting events all the time. It's one of Canada's longest standing organizations doing this kind of work, established in 1928. And you've seen this event as well as many others. I think more than 150 events organized on a regular basis to bring out these questions and dialogue on foreign policy. One of the key initiatives of the Canadian International Council is the Canada Speaks series, of which this event tonight is a part of. And this is born out of the Foreign Policy by Canadians initiative that the CIC has created. We're very lucky to have with us tonight a very special guest, Mr. Stephen Poloz. Thank you so much for making the time to be with us tonight, Stephen. We're thrilled to have you. I'll introduce Stephen very quickly, but of course want to make sure that we give as much time and we privilege as much time to hear questions and comments from our participants. And so you'll see that there is a Q&A function available. Please make sure to get your questions in early and often so that Stephen can speak to the things that are on your mind as well as mine. With that, I will turn just quickly to introduce Stephen Poloz. He is widely recognized economist with nearly 40 years of experience in financial markets, in forecasting and economic policy, including 35 years in the public sector. He's currently with Osler, but prior to that, Stephen was the 9th governor of the Bank of Canada, which is Canada's central bank. He was the governor of the bank for 7 years, after having previously spent, I think it was close to 14 years, occupying a range of senior positions. Stephen is also the author of a book titled The Next Age of Uncertainty: How the World Can Adapt to a Riskier Future. And we will hear him speak about that, the tenets of that book, along with folks to hear your questions as well. So Stephen, maybe I'll start with a very light and easy question, and then we'll see where this conversation takes us. Once again, thank you so much for being here, and thank you to our audience for participating tonight. So an opening question for you, I guess, to set the scene really. You've put out this book where you've talked about the 5 tectonic forces that underpin Canada's economic future. I'm wondering if you can start by sharing what those 5 tectonic forces are and what that means for where we're headed.
Well, sure. Well, thanks, Aisha, for the introduction and for having me here today. And thanks everybody for coming out. It's a real pleasure. I wish we were in person, but this is, you guys are everywhere, so I guess that would be much more difficult in any case. I do appreciate the opportunity to talk a bit about the book. It's I think I wrote it in about 9 or 10 months, but it feels like it's my life's work because so many of the ideas were festering for so long. I called the book The Next Age of Uncertainty. That's in deference to John Kenneth Galbraith, who wrote The Age of Uncertainty almost 50 years ago. It's my contention that we face a gathering and a confluence of forces with a lot of similarities to that very difficult period. I'm hopeful that we'll stimulate conversations both in the boardroom table and at the kitchen table. Now, I know you don't need me to point out that we're living in increasingly uncertain times. And of course, you automatically think of COVID or the war in Ukraine or something like this. But obviously, even way before COVID, we had a rising trend in volatility measures throughout the economy. And And most of what I have to say applies just as much to the global economy as it does to Canada. Canada just being a small part of that. What recent events have in common, such as COVID, the breakout of geopolitical tensions, the tragedy unfolding in Ukraine. These aren't things that I think we should be able to forecast. They're almost black swan, or they're black swan-ish in their character. But what they do have in common is that they've demonstrated over and over just how unprepared we are for eruptions of risk of almost any type. I think we're going to see rising economic and financial volatility for the foreseeable future. And the reason is that there are these major forces you alluded to acting beneath the surface of the global economy that will make us increasingly vulnerable to even small catalytic shocks. When I set out to write this, I thought I was working on something to help companies think longer term instead of being short termers, and just making the quarterly numbers. Economists think of the economy as almost like a bobblehead doll. It's going to do this a lot, but then it's going to settle down, at a place. And when it does settle down, it's on these long-term parameters. And again, to think about those things and realizing the things we usually assume are constant are very much not constant now. And those are my 5 tectonic forces. And the first, population aging. I don't have to remind you that 1 year from now we'll be a year older. That's an attempt at economist humor, which is not usually very, very effective. But the idea is that for the past 50 years, our demographic structure has been relatively stable because of the presence of the baby boomer bulge. And now the baby boomers are falling out of the workforce. That's 50 years of what we used to think was normal, but actually we're returning to a longer term normal, which is quite different. One with slower economic growth, lower interest rates, long term. Technological progress is the second one. There's always a little bit of technological progress going on, but we've only had 3 big waves of general purpose technological change. That's, of course, the steam engine in the 1800s, electrification in the early 1900s, and the computer chip in the 80s and 90s. We're now facing the 4th industrial revolution, which is the digitization of everything. And that gives us the kind of AI interfaces, built on those digitized models, and absolutely huge advances in biotechnology related to it. So the analysis of past industrial revolutions shows that they're always a force for good. They bring us a lot of new productivity and new increases in our improvements in our living standards. But they've also been hugely disruptive. And this one looks like it'll be even the most disruptive of all the past ones. Well, the good news is we managed the 3rd industrial revolution far better than we managed the first 2. The computer chip revolution, fairly recent. It was difficult, jobless recoveries and all that sort of thing. But we didn't have the Victorian Depression or the Great Depression of the 30s like we did for the first 2 revolutions. The 3rd tectonic force, rising income inequality. And I know that the audience is very aware of this, that we can see it everywhere. Over 70% of people in the world have experienced a worsening of income inequality over the last 10 years. Historically, rising income inequality, it comes in these waves during industrial revolutions, almost always accompanied in those revolutions. And of course, the reason is because companies make those early gains. I mean, they pluck all the benefits of the new tech, and regular folks are disrupted. We think 15% of the world's population will be disrupted by the 4th industrial revolution. That's a lot of people. And so what we get is this gradual increase in income inequality, and that becomes political. And so you get these stresses at the political level that we're not used to. Indeed, you get polarization, and that's the shift towards populism. We've seen that in many places. I don't have to remind you where. That is tapping into that vein of discontent, which arguably will grow a lot during the 4th industrial revolution. The 4th tectonic force, really quick, rising debt. Everybody's talking about debt. No wonder, not just household debt, not just corporate debt, which are all both at, post-war records, but government debt. Government debt increased by around over 20 percentage points of global GDP during the pandemic. Governments today have more debt, or around the same level of debt as we had after World War II. So obviously a major force to be reckoned with, especially given what I mentioned before, which is the demographics are going to be opposite to what we had after World War II. So actually shrinking workforce. And the fifth is climate change, not specifically climate change, specifically the forced energy transition to net zero by 2050. This puts a whole new disruptive structural overlay over top of everything else I've just mentioned. No one is clear about what the path is. There are many different paths between here and net zero. Business is trying to choose paths, chart out their investments. Governments aren't giving them much help. COP26, it's called COP26 because 26 times now we've met to try and resolve those things and be clear. And we're not really succeeding. And I think we won't succeed any better as we get increased polarization in government. So it's not going to be an easy task at all. And so all this means is these forces are coming, and they're actually getting bigger right now. We could analyze them one at a time and we'd all kind of reach a certain understanding of them. But what the book tries to do is consider what happens when they're all working at the same time and interacting. And it's those interactions which helps me explain historical depressions or the explosion of inflation in the 1970s. So these are very big economic events in our history. We use them to kind of frame our conversations about what's going on today. At the time, we thought they were totally weird. We know they were completely out of the blue. I think the combination of nonlinear forces that I'm describing, you can appeal to the mathematics of chaos to predict that the outcomes that we'll see will look chaotic. They will look completely unpredictable, just like earthquakes. Today, if an earthquake happened in California today, it would be unpredictable. But you'd say, well, we knew one was coming sometime. And so it's those underlying forces, the tectonic forces that give rise to earthquakes, but very sporadically. But when they happen big, they happen big. So that's the premise of the book. And the rest of it is all about how will people adapt to what I've just described, a much more volatile future, especially when I think governments will be ill-equipped to cushion us from that. I actually think they did a great job for the pandemic, and so people might be very comforted by that, oh, well, volatility's coming, but look what they did in the pandemic, it'll be fine. I think on the contrary, monetary policy it will be very constrained, and fiscal policy will be even more constrained by the legacy of debt and the growing baseline fiscal draw because of the aging population. So that's all to say that I think this rising tide of risk will come up to our doorsteps, your doorstep, my doorstep, and our company's doorsteps to manage somehow. Anyway, that's a short answer. Well, no, a long answer to a short question. Anyway,
there's so much to unpack there. I was going to start by asking you about the role of economic and fiscal policy in addressing some of these things, but clearly you've taken the words out of my mouth and said that they will be constrained. So I guess my question then instead will be, how does Canada fare in this case? Are we better off or worse off in terms of our preparedness? I think about we came into this pandemic, for example, with really great credit rating, that we came in good stead, and we're leaving, I would say, maybe in relatively strong stead compared to some of our allies around the world. And we've supported provinces and territories at the provincial level with, by taking on a lot of their debt. But how do we fare now? What are we looking like in the Canadian context?
I think you make an excellent point there. Well, first of all, Canada won't be alone in this. In fact, I'm almost a bystander compared to the big players. But we showed that the benefits of being well prepared, we were well prepared fiscally, for sure, going into the pandemic. At the time, we had roughly 30% of GDP as our debt ratio at the federal level. You'd need to roughly double that in order to include the provinces. Okay, so it's, to be fair, it's about double that, but still that left us in a better place than many of our other advanced economy partners. And at the time, we thought the federal debt level could conceivably go all the way to 60% of GDP, if the shock was really big. Of course it didn't. We now the latest budget shows it peaks at about 46%. So that's only half of the kind of rise in indebtedness that we conceived of, and reassured people that if it went to 60, well, that would still be less than where we were in 1994. So you kind of put that in context. You think, well, okay, we survived 94, we could survive this. But could we survive it if it all happened again next year? That's the real question, and I think we all need to rebuild our resilience through time so that we're ready for the next one. Canada also gets another leg up on others because we've all had for a long time a really strong immigration program, far more than many other countries. That puts us as, best in class in that respect. That's an important offset to the worker shortage that's coming through the aging of the population. But a caveat to that is that everybody's going to come to the same realization over the next few years that they need to up their game to attract more immigrants too. And so I think we won't be able to take it for granted that we'll be the most popular place to migrate to. So we'll be in a real competition for immigration in the next few years, and we're going to have to make sure we're doing a good job of it. But those are a couple of, I would say, comparative advantages for Canada, our debt level and the fiscal plan. I mean, look, I might have wished for it to be a more aggressive pay down, to get things back to a more resilient place faster. But I recognize the political reality. In fact, the political reality had me concerned that it would be much more the other side. About half of the fiscal capacity that was on the table has been dedicated to a faster decline in the debt ratio, and the other half has been deployed. That's a better ratio than I expected.
Thanks for that, Stephen. I apologize. I got kicked off very suddenly. So
hope that doesn't happen to me.
So I'll pick up a question that we've got from our audience. From Naresh Singh, are central banks, especially the Bank of Canada, doing enough to manage the risks due to climate change? I think connecting back into what you've said about these tectonic shifts.
Well, to be frank, I don't really think this is a province for central banks. I think our best plan is to have central banks focus primarily on their core job, and not accept a broadening of their mandates. They have very few, I'm going to say very few, but they actually have no tools to apply to climate change, except central banks that are regulators. Like the difference between Bank of Canada and the Bank of England is Bank of England is kind of like Bank of Canada and OSFI combined. Okay, so there's a sense in which the regulator has a role to play in addressing climate change and making sure those frameworks are robust. The main angle for most central banks is climate change poses risks to the economy and therefore to the financial system, and those risks need to be well understood and they need to be well managed and mitigated to the extent possible. So that, of course, is part of the core mandate of any central bank. But to flip that around and make it so that the central bank is actually making a contribution to the path to net zero, I think is beyond the pale. I'm just not a fan of the idea.
Yeah, Stephen, I'll come back to one of the points you started with about this rising income inequality, and it manifests in so many important ways. I think I would say for probably a lot of our younger professionals in the Canadian International Council, they're at the cusp of trying to buy a home, and there's no area where it's more obvious that there is a a shift in even their ability to purchase a home. And then, of course, the income inequality is evident there, and a lot across a number of other kind of spheres. So, what's your advice for some folks who are working on the policy side to try to to narrow that spectrum of inequality as much as possible?
Well, it's a great question. And this is a very important issue, especially for that cohort of people, but not only. Okay, I mean, you can take a typical family of four. We have this kind of life plan that we take for granted. That life plan is, okay, when you get to your job, then you kind of save up a bit, then you buy a house, then you have a family, and you pay for the house by the time you retire, and there's your plan. And this is kind of like a plan which it has an anti-debt philosophy. Like, debt is bad. So remember, I don't know if you remember this, but when I was a kid, my parents got excited to have a party the week that they finished paying off their car loan. They'd have people over to the house and they'd burn the piece of paper, that was the car loan. People would do this for their mortgage too, burn the mortgage party. And of course, they were old people by the time that happened. But, point is, they look forward to it. And I think that's fine. I'm not going to be an advocate for debt, but I do think that in a modern financial system, the best in the world, frankly, we can be a little more innovative around this. I think the basics are that we are going to build our future on an immigration plan. Therefore, it's for sure housing prices are going to continue to be rising. Even if we built a new dwelling of any type for every arrival, for every person, just the right number in the right cities, which of course would be unbelievable if that happened. But let's just suppose it did. It would mean that each of our cities was getting a bigger footprint. That's just the way it is, okay? Unless, of course, we change all the rules around densification, but we've seen how hard that is. So let's pretend that we can't do that. As a city gets bigger, a bigger footprint, what happens is the price curve of dwellings within that city looks like the Eiffel Tower. And as the footprint gets wider, the height of the tower goes up. That's just a fact of life. You're always willing to pay a little more to be a little closer in and have a shorter commute. I know that commuting is changing as we speak, but it's still going to be part of your life in some form or other, and there'll always be a willingness to pay a little more. So with that in mind, there's no magic solution to this. Even if you build all the right number of houses, existing homes will continue to go up in price, and people who are priced out today will be even more priced out in the future. So what I think we need, first of all, we do need more supply. Let's get that out of the way. But I do think we need some more innovation in the financial industry, in the mortgage finance space. So if a family, let's say in the city of Moncton, can achieve the life plan I described before, say because the house starts out at $400,000 or $500,000, they can manage this with that two-person income. The same family might be living in Vancouver, and for them it's impossible. They can't possibly get there from here. And yet, why can't they just build equity in a home up to about the same amount as the folks in Moncton, $500,000? And then when there's time to retire, they just sell their house and they retrieve their equity. But they still owe like $1 million, right? So there's no shame in that. It's just financial intermediation. All you need for that to work is an investor who would like to own, 2/3 of a house. And it's co-ownership. You get over it, you build your equity, then when they sell, they do it again with somebody else. And there are investors that are willing to do this. Who's not willing to do it is our banks, or at least our framework I've described. We can't seem to manage this. So I think we're going to see a lot more innovation on that front. The last thing I'll say is my generation is the richest ever. And most of that wealth is in the form of real estate. That real estate value, that wealth will not get destroyed. It'll be there when I'm gone, when others are gone. And so, yeah, maybe we're going to live longer than our parents did. In fact, I hope so. But That just means that my kids have to wait a little longer than I did to inherit a little something from dad and mom. So I just think that this is something that kind of intergenerationally will work itself out with a little bit of patience. And I don't mean that everybody stands to inherit a house. I know that's not true, but that's a huge stock of wealth that will go to the next generation and get distributed in some way. And I think the idea that we can replicate what our parents did now that we're in a much more modern and bigger and more vibrant economy is just kind of a story. We can't expect that. And I hope that's not too gloomy. But
No,
anyway,
no.
I think it's the fact.
I mean, I'll set aside the fact that you've told me I have to get out of my pajamas and start commuting back to the office soon for a separate conversation.
Maybe not every day, Aisha, maybe not every day, but some days.
But you talked about I guess two things I really wanted to pick up on. One was, of course, this idea of intergenerational wealth and how we can spread that out more equitably, because of course it's not, the folks who are benefiting from intergenerational wealth don't look like the entirety of the population of Canada. And so there's potentially, policy solutions that we have to think about. But I really want to pick up on your first point around, this sharing of housing, right? And something that Canada has really been thinking about a lot is around foreign investment and foreign direct investment. And I think there's something to unpack, not only with respect to housing and to real estate, but also, foreign business investment as well. And so this picks up on a question from Christopher in our Q&A, who says, what needs to happen to encourage higher rates of business investment? And could there be an opportunity for more foreign direct investment in that case?
Well, you've hit a nerve there, Chris and Aisha. So we often hear this. Canada has been a true laggard in it when it comes to productivity, output per person, however you want to measure it. We are way down, like almost in last place in the OECD in terms of how we're doing on this front. And so it's natural to kind of look at, well, geez, companies are supposed to be investing and giving us all the latest stuff and be more productive. And so I guess they aren't. And if you look at the data, it sounds like they aren't. So there's kind of a natural tendency to blame companies for this. I've spent a lot of my career hanging out with companies. When I was at EDC as chief economist and then as CEO, I was always visiting companies and having dinners with companies. And I continue to do that as governor. And I find that all the productivity stories are out there, they're everywhere, except in the statistics. So I have to ask myself, well, what really is going on and why are we lagging? I think it's not because of businesses, although they are the ones doing the deciding. It's because we throw up so many roadblocks that prevent them from doing their thing. Businesses are looking to expand. Oh, well, just a minute now, you're going to have to get some permits for that. This can take you years to get yourself permitted to put an expansion on your factory. Interprovincially, if you're in a service business, well, there's rules that are different from one province to the other. Can you build a scale business when you got to chop it up into little pieces? The furnace producer makes furnaces for your home. There are 8 different specifications of furnaces across Canadian provinces. We can't even agree on what are the specifications for a furnace. So the interprovincial regulation differences, that's a huge roadblock to productivity. Roughly 4% of GDP left lying on the sidewalk, free money. All we have to do is pick it up. How about LNG? 7-8 years ago, we could have approved 2, 3, 4 out of the 12 proposals for LNG's facilities. We approved 1. Okay. If we had 1 more this year, another $8 to $10 billion worth of exports of LNG to our European friends who badly need it. But no, we didn't do that. Okay. We're not in a position to do that. We can't decide things. We throw red tape at everybody. I think government, instead of having a grand scheme for boosting our productivity and somehow coercing companies to increase their investment, should instead try to take the barriers out of the way. That's low-hanging fruit. That's my little rant for the evening, because I just think we ignore the obvious things, and then, oh, but we'll have a new proposal or announce this, that, or the other thing, and then nothing really happens. Why? Because the impediments are still there.
You've picked up on something really that I'd like to probe. You've spoken a lot about the domestic barriers that we've put up in our way, but perhaps this connects really onto the global side. And a question
Sure.
from an anonymous attendee about, can we conclude that globalization is dead? And if so, what comes next? Are we in a better place with respect to those types of barriers?
Well, the kind of barriers I just talked about for domestic investment are there for international investors too. I mean, they're looking at Canada and saying, well, I'd invest in that if only they'd get their act together and decide something. Give me clarity on how I will make money out of my investment. Approve my project or something. Okay. So I think many of those arguments apply equally to foreign direct investors. But getting back to the broader idea of globalization, no, I don't think it's dead. The economics of globalization are too profound. This would be like very similar to me saying, Aisha, I think you should start doing your own dry cleaning because you'll save a bundle. Okay. Well, really? You're going to eliminate a couple of jobs in the dry cleaners business. And that's bad, but also you're going to eliminate hours and hours of your time that you better be placing on some other things that are actually your expertise. And that applies equally to international trade and global supply chains. There's a great deal of money at stake. And so when I talk to companies, what they suggest to me, they have no intention of deglobalizing in the sense of bringing everything home. If they get forced to, they're just going to use a really high capital labor ratio in the new setup. They're going to have robots and everything doing everything, and you won't create the jobs that the politicians hoping they will. So that's going to backfire if that's your plan. But with deglobalization in the sense of managing the risks or de-risking the supply chain, if you've got one supplier for a critical component, that supplier could be put out of business by a strike in a port, either here or there. It could be put out of business by a storm, just weather, or it could be a geopolitical intervention, right? It could be something that just goes wrong. So how do you de-risk that? Well, you have 2 suppliers, 3 suppliers. You split the mandate so that you've diversified that. It won't be perfectly optimal. It'll be a little bit suboptimal, but not so suboptimal as bringing everything home and destroying the value that you've created. And so I think that de-risking thing is going to go on. I think deglobalization to some degree, and maybe most importantly, no more penetration perhaps of globalization, which we think has kind of been one of the factors that helped inflation be lower than expected, on average around the world over the last 20 years or so. That's been, we called it the Walmart effect for a while, right? It's the globalization of trade, a much more diverse sourcing of trade, and what that delivered benefits in the form of lower prices to consumers. That trend probably, it looks to me like it's over. And geopolitically, I think we're going to do some true exclusionary policies right now with Russia. And, maybe we'll be even more cautious with our relationships on other fronts. So there's, to a degree, the question has merit that it's going to happen to some degree, but I don't think it's going to take away the vast majority of the benefits of international trade. And companies will maybe friendshore, as Janet Yellen has said, you're more likely to go to places where it's a friendly arrangement and you've got good standing legally and that kind of thing. But I reject the idea that we're going to go isolationist.
Stephen, I'm scanning through a ton of questions that have come in, and I'll just thank all of our attendees for their very, very keen engagement. I'll turn over to some of the questions that we've got here, just so that folks have an opportunity to hear from you about things that they want to raise. One key here is, do you think current levels of inflation will be short-lived, or do you think that it will last long enough to affect the 5 spheres you identified?
Excellent question. So in the near term, I think that the inflation story has been overdone. I think that we have to think of inflation as having 2 parts. One part is truly exogenous. There's nothing we can do about it. If somebody's going to double the price of oil because of a war or some other scarcity, we'll have to pay more for gasoline, for our cars, et cetera. Let's assume for the rest of our lives. Well, what that means is the price of oil jumps up, and over the next 12 months, inflation is high. And then 12 months later, the tail end of your calculation of inflation pops up to the higher oil price. And suddenly it's not inflation anymore. It's a higher price forever, not the same as inflation at all. And I think a lot of what we're seeing is that. It's oil, it's certain food categories, it's fertilizer, which connects to food. It's also catch-up. Prices went down during the first 7, 8, 9 months of the pandemic. Then they came back up again. That's not inflation. That's a part of our normalization process. Example, hotel rooms. Hotel rooms are still about 30% lower than they were in Toronto, for example, when I went down to Toronto just before the pandemic. But they're 100% higher than they were a year ago. That's a lot of inflation, right? And it's in the consumer price index, but it's still lower than they started. So it's not inflation, okay? So some of that stuff we have to set aside. What really matters is the homegrown part of inflation, which comes from excess demand in the economy. And it looks like we have excess demand. We have the lowest unemployment rate on record, and we have almost 1 million empty jobs waiting to be filled. That's excess demand, and that has the potential to raise inflation. Central banks are actively dealing with this. I'm confident that it'll get dealt with. It may take a little longer than you first thought, but the part that I said before, the exogenous part, it is temporary, okay? Transitory, whatever word you want. It means it goes away by itself in time. So, but let me set that aside, because in the book, what I deal with is not so much that, but the longer term question, which I think is where this person is going. So what I'm arguing actually in the book is that the interaction between the geopolitics, in other words, the divisiveness that we get from rising income inequality, with the big debt legacy that comes from post-pandemic, that interaction is a dangerous cocktail. There's a huge incentive for governments to lean on their central bank, to keep interest rates lower for longer, to let inflation run a little higher. The big beneficiary of the big inflation of the 70s was the government. The second biggest beneficiary were highly indebted households. Well, we got plenty of both of those right now. So I just can imagine a scenario where a politician comes to the ring, the arena, and says, I think inflation is not such a bad thing. I think we could run inflation higher for longer. It would be good for the debt that we ran up during the pandemic. And moreover, it's good for households. They really benefited in the 70s, and highly indebted households just might vote for it. That's a kind of a risk, the interaction between those things and that politics, especially divisive politics, that we need to be aware of. I think the risk of inflation being higher in the future is a higher risk than we've had for the last 30 years. I don't mean that it's going to happen, but I think it just means, like all the predictions, none of these are bell curve predictions. They're just saying there's a wider range of possible outcomes, and we need to prepare ourselves for all of them and not assume that they're just tail risk events.
Thanks for that, Stephen. I've got one person here who's very eager to ask a question, so I'll read it and welcome your views. It's from Clara, and her question is, what do you think of the loss of supremacy of the US dollar at the international level? what could be the impacts of Canada? Do you think the international financial system should get back to relying on the gold standard?
Let's see. No, no, and no. I think that's the right answer. But anyway, first of all, I don't see a loss of supremacy of the US dollar. I think there's a natural process there where, renminbi over time should become more important. It's just the biggest economy on earth, will be. And, actually promoting an exchange system so they don't have to use a vehicle currency is a legitimate aspiration. And it would not put the dollar at risk. Right now, the US dollar is in ascendant, and it really is, beating everything right now. I think that's more likely the outcome than the one that's being described here. And I guess referring to the gold standard as some sort of bastion of stability, I'm probably putting words in the mouth of the person that asked the question, but I think I sense that, that sense of solidity is what they have in mind. It was a really, really bad monetary framework historically. It was really being under the gold standard that caused the interaction between the first and second industrial revolutions, those interactions with outstanding debts, okay, give deflation, okay, it gives us these bouts of deflation that interact with outstanding debts and gave us those two depressions. The Victorian Depression was 23 years long. The Great Depression was 10 years long, but it was really only resolved by the burst of government spending related to World War II. So it could have lasted much longer. Whereas we managed the third industrial revolution much better because central banks had the ability to expand the money supply. When an industrial revolution is creating more capacity, more ability to grow the economy, what you need is more money for it to function. Under the gold standard, we couldn't get any more money unless somebody found some more gold. And so what happens is as the capability rises, the price level must fall. You get deflation in the economy, which is a very dangerous combination with debt. So I don't think the gold standard, or for that matter, a Bitcoin standard or any of those standards has half a chance of doing as good a job given the future I'm describing as the framework that we have today.
I'll pick up on your Bitcoin comment and ask a question from David. He said, you've mentioned this digitization shift and that it will change our lives quite dramatically, of course, and the digital economy is putting a great emphasis on those structures. How do you think the traditional banking system will deal with this shift? The blockchain technologies that will enable financial transactions without the needs for banks. It's a pretty significant shift that we're seeing in that regard.
Yeah, so people ask me that, and I wonder why they would want to do a transaction without the need for a bank. It's kind of it's like I know criminals really like to do that, but I don't find it a burden or anything to do my transactions through a bank. And indeed, in less than a year, we will have a fully real-time settlement system at the retail level. Right now, we have it at the wholesale level, just for large transactions. But you and I will be able to exchange funds instantly between ourselves. It'll still run through a bank or both of our banks if we have different banks, but it will happen instantly. And in that kind of environment, I don't see the value being added by a digital money that's independent. Okay, I think there'll be a value from a digital money that's official because it's just going to be super convenient. You may not wish to. I don't know if you have any banknotes on your person, Aisha. I'd still carry some for, I don't know, tips or whatever, or in parking garages or whatever. And I carry them because they have my signature on there. I like that. But a digital money won't have that. But it also won't have that same sense of simple, transacting quality. So the digital monies that will come on stream in due course, whenever we're ready for them, central banks will do them. And those things, what they'll do is they'll just replicate cash. Cash doesn't bother the financial system. Neither will a digital cash. There's, fear mongers that say, wow, that's going to mean we all have an account at the central bank. That's not true. The central banks will, of course, administer a digital money, and they'll promise to you, just like your bank promises you, that they will not give out your information, your transaction history, without a court order. And that's what your bank would do. And so that's as private as it gets. And if you're really afraid of that, then I think you might be thinking about doing something illegal. But underneath Bitcoin, there's a fabulous technology which is going to be used all over the place, already is being used. One of the best examples I've heard of is, how, like these fancy handbags that women pay huge amounts of money for, or their husbands or boyfriends do when they're shopping for them, whatever, but they're really expensive. And once in a while, a box of them falls off the truck. And, if you're in Turkey or someplace, you can get a good deal. Well, that won't happen because what they're doing is they're putting all those handbags on a blockchain, and they know where each handbag is. This is the kind of thing, same thing for art, replicated art, of course. Those kinds of things can all be registered on a blockchain. Everybody knows where they are, and you can't somehow have extra ones, that's going to reduce a lot of errors. It's going to reduce a lot of potential for fraudulent activity and so on. There are lots of other applications of the blockchain, which I think are going to be very powerful. But in the settlement of payments where there's a natural central intermediary, like a central bank, it doesn't really have the kind of benefits that are being thrown at us. So there's a future there, and maybe Bitcoin and others will remain as some sort of an asset class, but I kind of doubt it. I think if I was to start a company, Aisha, today, and say to you, Aisha, I'm giving you the opportunity to get in the ground floor. This is a company that will never have employees. It will never have any earnings. It'll never turn a profit. It'll never have any customers. Would you like to buy the stock? I'm going to give you a good deal on the stock. And you'd be like, well, okay, maybe. Doesn't sound like a good proposition. That's Bitcoin. Because it has an intrinsic value of exactly 0. And so I think it's going to lose its appeal as the environment becomes more digital. But anyway, I could be wrong about that. So some people want to keep a little bit of Bitcoin in their portfolio as a diversification play. It's okay, more power to them, but it's basically a Ponzi scheme.
Yeah, that's, I think, you've spoken to some of the really serious cons of that. And you've mentioned the central bank's digital currency as well, that they're trying to get into that game in a sense, right? Yeah. I wonder, if it is a little bit of a inflated value created just by word of mouth or by excitement. Yeah. What is the central bank going to do about that? Is it just going to try to, is it affecting our global economy? Do we need to still continue to worry about it, or should we just set it aside as a little bit of a blip?
Well, look, some of these, I want to try to distinguish crypto from, let's say, payment systems, okay, just for sake of argument, because you remember when Facebook first floated their idea of Libra, they called it, and that was to facilitate payments on their platform. That proposal had real power because it's very expensive right now through the traditional banking system to do cross-border payments. Like if my granddaughter was in Africa doing one of those charitable things like building houses or whatever they do, and ran out of cash, I could get her money, but it might take pretty well a week, and it would cost a lot of money to make that transfer, even if it's a small one. Whereas on Facebook, you could just go on and say, look, here's some money, and it would happen instantly. So cross-border payments is something that needs addressing. So it fills a niche. Well, it's not happening now, but somebody may still do that. I think there's real promise in some of these things, and yet, in terms of it being an actual money, I'm just not seeing it. Because if the need is arising for digital money, then it's the natural role for central banks to provide it, just the way they provide banknotes now. It's part of their responsibility. So I think that's what they will do. And if you're playing around with a money that's completely different kind of money and it's digital, it'll just kind of get edged out by the power of the official money. Just the same way, most of us don't carry Canadian Tire money in our pocket, except on the Saturday when we're heading over to Canadian Tire. Oh yeah, I'm going to take my Canadian Tire money, but you don't carry it around with you all the time in case you need it, right? And so I think I don't know. I think crypto has kind of caught everybody, caught the imagination in a way, and there are roles for it to play, but not a generalized role.
Yeah, I think the only one who still carries around the Canadian Tire money is my husband, and you should see the size of his wallet. I don't, I hope he hears your advice in the other room. That's great. We've got about 7 minutes to go, and there's a ton of really interesting questions still in the chat. And so maybe this one, I know which one I want to end with, but I'll ask this one next because I think I'm keen to hear your reaction. Some folks are thanking you for being able to be so candid, and that's great. And I think you know where I'm going with this now, Stephen. We've heard from political parties, some of them, if elected, have talked about changing the roles and responsibilities and accountabilities of the central bank. And so do you think that this is a good evolution, or do you think that there continues to be value in an independent central bank?
Oh, listen, I think there's tremendous value in an independent central bank. If nothing else, we just have to look at history. All of the major eruptions of inflation in our history have been either because there was no central bank, or because a central bank that was not independent was heavily influenced by politics. And that would include the Federal Reserve in the late 1960s, that coercion that took place during the Vietnam War when the government was having a lot of trouble financing itself, leaning on the central bank to keep rates low, even though inflation pressures were emerging. It basically caused the Bretton Woods system to explode and caused them, US to have to close the gold window, drop the gold standard. And then, of course, the great inflation that was shared by all the countries that were connected there too. You just have to look at Turkey today and say, well, there you go. That's what it looks like when a government leans on their central bank. So independence has a lot of value. It means there for all of us, because it means that central bank pursues a clear goal, usually described as inflation. Historically, they've done a terrific job. We've got a blip right now, that's for sure. I understand all that, but let's set that aside. The historical performance has been superb, and that has made our economies function better, more efficiently. It's given us lower average rates of unemployment, less volatility, and it's meant lower interest rates. Okay, because interest rates would be higher if there was that uncertainty. So all that to say, I also argued before that we're in an environment where the long-term inflation risk looks a little bit scary because of all that debt and the temptation for governments to try and influence central banks. Now, I'm talking globally. I'm not talking about a specific central bank in my answer. So I just think for all those reasons, independence is something to be valued. There are different forms of independence across different central banks. Canada's is different from America's, and different from the UK, and different from the ECB, and so on. But there's always a form of independence which gives markets some confidence on that front.
Great answer. All right. I know we haven't been able to get to all the questions, but this one is the doozy. I think that will either have people hiding under their covers or freaking out in their homes. What are the things that keep you up at night when you think about this? What is the exactly that? What are the things that keep you up at night when you think about this? The top 3 things.
Well, top 3 things. My goodness. Well, right about now, I like to think of things that seems like nobody else is. And the thing that's keeping me awake right now is that there are a number of very fragile but large economies out there, economies that did a lot during the pandemic, did not have the fiscal capacity that we had, but basically walked in our footsteps, did it all, and now have that debt plus political fragility. So I'm talking about a place like Brazil. That Brazil's got me concerned. And so, Matt, I look out the window and all that stuff that's going on right now, and just imagine if what we layered on top of it was like something like the Asian financial crisis from 1997. Okay, but led by, let's say, a Brazil, or, well, for that matter, Turkey. But anyway, Turkey's not big like Brazil, not quite anyway. But anyway, so that's got me concerned. The inflation side has me less concerned short term, but of course, as I discussed, I want to keep that high on my list, because I think there's a lot of places in the world where central banks are vulnerable to being pushed by politics, and the politics can get more rabid as we go forward, as the divisiveness grows. And my last thing is that we are not treating the income inequality issue as seriously as we should. The amount of global income that is going to labor as opposed to capitalists is the lowest in recorded history. And this concludes all the history that Piketty documents in his book. And that's to say, we've got those kinds of ingredients that foster revolutions at times. I believe in the future, the very near future, the power is actively shifting from employer to employee as worker shortages emerge, and we disrupt everybody with the fourth industrial revolution. That's going to put tremendous stress in there, and is going to give us a lot of things that we're not used to seeing, like a renaissance of unionization, if companies don't get in front of it. Like you've seen Walmart and Amazon, like they're like, oh, we're going to pay people better, people say, oh, I don't want to go back to the office every day. Like I hear that over 50% of Canadians are looking to change jobs right now. And no wonder, there's 1 million job vacancies. There must be some of those that would suit you a little better than the one you have now. And the average job changer in Canada gets more than 10% increase in pay. So these are all things that I think you're going to see a renaissance of defined benefit pension plans, because companies will need to, attract and retain much harder than they have in the recent past. There's lots of implications like that, because if they'll say to their shareholders, oh, we failed to meet our business plan. Why? Because we couldn't get enough workers. Well, come on. We know how to get workers and, satisfy them and get the job done and retain them. We got to protect them from the risks that they face. We got to make sure that their needs are taken care of. We're not going to treat them like, inputs, right? And if you do that, they're going to be loyal to you forever, and they're going to help you achieve your business plan. So I think that what we're going to see is the broadening of the S of ESG. E is becoming much more focused and defined. G is easily understood now, but S is still this vague thing. And I think it's on the S front where we're going to see companies really innovate as we go forward.
That is a fascinating way for us to close out. Stephen, I can't believe our time has run out so quickly. Thank you so much for all these insights. I have to say, I'm not as scared, maybe on the first two about the more fragile economies, but that last point, as a worker, I'm thrilled with hearing that. But thank you for all your insights. It's been really great to have you tonight. I want to thank all of our participants for your wonderful questions, your clearly engaged and thoughtful interventions. And a special thank you from my part to Power Corporation for sponsoring this event, as well as to the folks who have been making this event possible. I'm thinking specifically of Catherine, of Lillian, and of Jillian. Thank you all very much. I know that the CIC runs so much better because of the support of folks like you that made this event possible. But once again, Stephen, thank you so much for tonight. And we will hopefully have another conversation to pick up on some of these points in the near term.
Okay, well, thanks very much. Pleasure to be here. Bye-bye.